In this section of the lecture, I'm going to be talking about a first main theme that characterised the period between World War II and the present. This is globalisation, or what's sometimes referred to as reglobalisation of the world economy. So, in previous sections of lectures, we've talked about the initial, or what's often referred to as the first year of globalisation from 1820 to World War I. We've talked about how that was disrupted by world wars and the Great Depression in the period from World War I through to World War II. Reglobalisation happened after World War II. Initially sort of quite slow from 1945 to the 1970s and rapid since 1980. Often this period of reglobalisation is broken up into sort of two eras, what are referred to as the Bretton Woods period and after, for reasons that will become evident during the presentation for this section of the lecture. By the late 1990s, the issue of sort of globalisation and reglobalisation had become a significant topic of debate, with severe critics of globalisation and also proponents of its benefits. This slide is a picture of the Battle of Seattle in 1999, where protesters sought to disrupt the meetings of the World Trade Organization that were being held there. And this in particular was a time which became a real flashpoint for sort of discussion and analysis of the role that globalisation was playing, both economically and socially. In this section of the lecture, what I'm going to do is use the same structure for thinking about globalisation that I've used before, talking about trade in goods and services, capital flows and migration to describe what happened, and then finish up by saying something about the consequences of those developments. Starting off with trade in goods and services. So these are data from 1960 through to the present from the World Bank, and basically they show sort of during that period, fairly steady, some tailing off during the global financial crisis, but we can draw a pretty straight line through there saying that there's been steady increase in trade in goods and services over that period. So about imports and exports accounted for about 20% of GDP globally in the 1960s. Nowadays that's up above 50%. Why is that increase in the extent to which countries are trading goods and services with each other happen? One factor is the evolution of policy making. So we've talked before in the previous lecture about arrangements after World War II and the development of GATT, the GATT organisation, and reductions in tariffs that came out of that. And so those reductions in protection against international trade have certainly acted to promote international trade. There are limits on how much protection against international trade is undone. For example, there are still high levels of protection against trade on agricultural products in many parts of the world. We know developing countries didn't reduce trade barriers against each other as much as developed countries did during this period. And we know that in more recent times there's been a shift away from multilateral type trade arrangements where everyone receives the benefits of a lowering of protection against international trade to more bilateral, which is country-on-country agreements. So policy making has been important, but there's been limits on that as well. Second factor is just the fact that during this period after World War II, there was growth in income, which increased demand for traded goods. A third factor is, in more recent times, is the return of comparative advantage and specialisation. So the idea that different countries are increasingly specialising in production of goods in which they have a comparative advantage at that time, and that specialisation then gives rise to a greater amount of international trade. So, for example, China having had a phase where it was specialising in production of footwear and apparel, now moving on to be specialising more in production of particular types of electrical equipment, and that gap in footwear and apparel then being taken up by some other economies like Vietnam and Bangladesh. Fourth factor is declining costs of trade. So while this wasn't as important a factor as during the first year of globalisation, the introduction of jet engines, the introduction of containerisation in ocean shipping did reduce the cost of transport in a way that's likely to have promoted international trade. There are also some idiosyncratic effects. So one study has looked at the role of the CIA. So where the CIA had a role in a particular country, the study finds that that country then increased its imports from the United States. Didn't increase its exports to the United States, so it seems like there was a spillover effect from CIA activity on promoting markets for US goods and services. Also, we know that colonisation matters or colonial links between countries matter for trade. So that, for example, when we think about episodes of decolonisation occurring in the aftermath of World War II, that to some extent sort of broke down the trade links that had existed between those countries. This is a table that just gives you a feeling on why containerisation might have mattered for international trade, showing how productivity of dock labour increased with containers, how the average ship size could be increased, how with containers you tended to get greater economies of scale in the number of ports that were used, and how containers were seen as a lot safer way to ship and therefore reduced insurance costs. This table gives a perspective on the relative contribution of the growth in output and the change in trade costs to the growth in international trade. So this period here is the sort of last part of the first year of globalisation, and you can see that between these two things, growth in output and changes in trade costs, the big factor driving the growth in international trade was reduction in trade costs. If we look at the period from 1950 to 2000, we see that there's been a much larger effect for growth in output. There's still some significant role for a change in trade costs, but relatively speaking, the contribution of growth in output to stimulating trade has been much greater during this period. Second aspect of globalisation is capital flows, and this is a graph of gross foreign investment measured in terms of assets as a proportion of world GDP. And basically you can see the takeoff sort of after 1960. 1960 assets, percentage of world GDP that represent foreign investment, less than 10%. By 2000, basically getting up to be the same as world GDP. So a massive expansion in capital flows during this period. Why did this happen? Well, partly it was to do with policy on international capital flows. You remember that in the initial period after World War II, the international financial system was governed by Bretton Woods. Bretton Woods effectively said that we're going to have fixed exchange rates, but we're going to allow governments to adopt independent macroeconomic policies. The only way, according to the macroeconomic trilemma, that can work is if you restrict international capital flows. So for the Bretton Woods system to work, you needed restrictions on capital flows. By the 1960s, however, there were ways increasingly in which financial market participants were getting around those restrictions, motivated by differences in inflation rates between different developed countries, so trying to sort of exploit those differences with capital flows. The United States, which had been the benchmark country in this financial system, basically the US dollar provided the reserve currency against which to which other currencies in the Bretton Woods system were tied. The US is playing a diminishing role in the world economy, and there are inflationary problems in the US as the US needs to pay for the Vietnam War. That leads to the breakdown of the Bretton Woods system, and by the early 1970s, basically the international financial system has changed to one where countries adopt floating or flexible exchange rates. And now that means that you can have independent macroeconomic policy, you can have free capital flows because you've got flexible exchange rates. And so in the period after the breakdown of the Bretton Woods system in the early 1970s, you get countries removing restrictions on capital flows, and that accounts for why you start to see such a spectacular takeoff in the amount of foreign investment, for example, in other countries. Second factor is that there's big advances in communications technologies, and financial markets become much more sophisticated. A third factor is you have a change in international patterns of production. So this is a period where you have the multinational corporation setting up operations, doing foreign direct investment in other countries, often motivated by trying to get around tariff protection that might have existed in those countries. But that's a driver of international capital flows as well. Multinational corporations doing foreign direct investment in other markets where they want to operate. This is a graph which just shows the evolution of policy on capital flows, sort of making the point that if you look at sort of that we had sort of relatively open capital markets in the period before World War I, then more restricted capital markets, because I should have mentioned that the idea of sort of opens up the top here, closed is down the bottom. So we start off relatively open, then markets become more closed. They remain relatively closed during the Bretton Woods era, but then in the period after that we see liberalisation of capital markets. Immigration, several comments to make about that. One is that immigration is still an important phenomenon around the world today, but there's a smaller proportion of the population involved in migration than was the case in the first era of globalisation. So for example, there were 8.8 million immigrants to the US in 1901 to 10, and 9 million from 1900 to 2000. And so obviously that's a much smaller, the absolute number's similar, but it's a much smaller proportion of the US population in that latter period. So migration is still, significant, but it's less important than in that earlier era that we've talked about previously. A big change is in the nature of migration. So whereas in the first era you had predominantly sort of young males migrating from Europe to the new settler economies, today migration is balanced by gender much more. And the primary inflow and outflow destinations have changed. So whereas in the first year of globalisation we saw migration sort of predominantly away from Europe towards the settler economies, nowadays if we're thinking about the developed economies, the balance of migration is much more even. For example, there's been growing migration to Europe, and in the period after World War II, a lot of that migration has actually come from their colonies, the colonies of European countries, France, the UK and Netherlands, after decolonisation. Okay, what have been the consequences of this phase of reglobalisation? First of all, what has it meant for economic growth? So there's a variety of descriptive evidence that suggests that countries which are more open to international trade have faster rates of economic growth than closed economies. So here's sort of a graph that, for example, makes that point. So on the vertical axis is GDP per capita in 2010, and on the horizontal axis is an index of trade costs relative to the average trade costs of the group of countries in the study that was used to derive this measure of trade costs. And basically the point is, if we draw sort of a line through this, we can see that essentially there's an inverse relationship between GDP per capita and trade costs. That the higher a country's trade costs are, like Syria, Benin, the lower their GDP per capita down here is likely to be. Whereas countries that have sort of trade costs that are below average, Singapore and Australia, they're more likely to have high levels of GDP per capita. Of course, correlation isn't causation, and it's possible that another factor is driving this relationship, such as good institutions. But there's also been a recent generation of econometric, statistical economic research that has established more robustly a relationship between trade and growth. For example, comparing countries that liberalised their trade restrictions in the period before the 1980s and countries that didn't do that, and then comparing their economic growth and finding that the countries which did liberalise experienced more rapid economic growth in the period after that than the countries that didn't liberalise. So there's a reasonable argument to be made that countries that liberalised their trade protection during this period experienced benefits from that in terms of their rates of economic growth. What about capital flows? We saw this big takeoff in capital flows. What's that done? Well, in the first era of globalisation, remember, capital mobility was really instrumental in the development of many of the settler economies. So capital flows from Britain to places like the US, Canada, Australia were integral to their rapid economic development. In the second era of globalisation, the nature of capital flows has been very different. Large amounts, or the largest amounts of capital flows, have been between rich countries. And we haven't seen the same proportionate flows of capital from rich countries to poor countries that we saw in that first era of globalisation. So in terms of the volume of flows of capital, poor countries haven't benefited in the second era of globalisation in the same way that they did in the first era of globalisation. Where studies have looked at the effect of capital flows on developing countries, the poorer economies, they find minimal benefits in terms of economic growth for those countries. Partly that's to do with sort of the minimal extent of the flows, but partly it also seems to be to do with the misuse of some of those capital flows, or those capital flows not being applied to economically valuable activities. And so, you know, out of various debt crises in developing countries, there have been proposals, for example, to have for some countries to be nominated as odious debtors to prevent them being loaned to by financial institutions in richer countries, because of the idea that the money going to those countries would essentially just be wasted. And so the idea is, look, capital flows to poorer countries don't seem to have provided a lot of benefit in terms of economic growth. You know, maybe that's because those countries that money's been misdirected because those countries don't have appropriate capital market type institutions or have poor political institutions, which mean that the money is essentially being not used in the general interest of the population in those countries. Other consequences, well, as with previous episodes of globalisation, there have been winners and losers. If you think within the developed countries, then consumers have benefited a lot from the fact that they're able to buy manufactured products which are produced in Asia, for example, at much cheaper prices. But the losers have been workers in competing sectors in, for example, the United States and other developed countries who've lost their jobs when their businesses had to close down because they couldn't compete with the supply of those manufactured imports from lower wage countries in Asia. And that was one of the motivations for the Battle of Seattle, the idea that globalization was creating, it was argued, too many losers in the sense of people who were losing jobs, who were being made less well off by increasing international competition. Inequality. There have been effects there. So within country inequality, partly related to my point about winners and losers, but also global inequality. To the extent that international trade, and there is some extent to which it seems reasonable to attribute it to this, to the extent that international trade has been responsible for the growth in income per capita in countries like China and India, the extent to that has raised very large numbers of people in the world out of poverty or given them higher incomes, then we can think of international trade as having some beneficial effect on a global scale in terms of reducing inequality, even though it might have widened inequality within some countries. Globalization has definitely affected the autonomy of national economic, activity. So, for example, greater linkages between different countries mean that it's more likely that a business cycle will be transmitted from one country to another. So if you think about the close integration of US and European financial markets, that's why the global financial crisis was transmitted from the US to Europe, or at least one of the underpinnings. And there are also, through, for example, participation in the world economy, constraints on policy making that develop for countries, for example, needing to abide by conditions of international treaties. Another controversial issue has been the effect of globalisation on environmental and labour standards. So, for example, the issue of of companies offshoring production of manufactured goods that they sell to developing countries, or locating their own factories in those countries to produce manufactured goods. And here there's probably two perspectives. So some proponents of globalization have argued that in fact that activity of manufacturing, of offshoring manufacturing, raises the environmental and labour standards relative to the average standard in those countries. The counter-argument is, though, that often there still seems to be an acceptance of lower environmental and labour standards in the offshoring activity in those countries than would be accepted in the country from which the activity is being offshored. So perhaps environmental and labour standards are raised in, say, poorer developing countries by these offshoring activities, but that doesn't mean the standards are still what manufacturers would have to adhere to if they were producing in developed countries. To finish up this section of the lecture, I want to present a contrary view about the idea that this period after World War II has been an era of globalisation. And this is a perspective that comes from the economist Pankaj Ghemawat. Ghemawat asks, is the world really flat? And he does that by presenting statistics on a variety of aspects of our daily life and economic activity. He asks how much mail, phone traffic, internet traffic crosses national borders. He asks how important is immigration. He makes the point that while we might point to the growth of exports and imports as a share of GDP, meaning that there's more international trade, that's likely to be exaggerated to some degree by longer and more international production chains. And he makes the point that most investment is still in the home country. This is sort of a graph that I've taken from Ghemawat's book, constructed from data in his book, that sort of makes his point. So Ghemawat's making the point that, look, only 1% of mail actually crosses international borders. Less than 20% of internet traffic is across national borders. 20% of time readers are in countries apart from the US. First generation immigrants are only about 5% of population in different countries. Most people donate to charities that are within their own countries. Most people have their bank deposits in their own countries. International university students are a tiny proportion of international students. So Ghemawat isn't really arguing that we shouldn't think about globalisation as a major phenomenon, or he isn't really arguing that there hasn't been any change in the period after World War II. But what he is saying is that, look, you can overstate to the extent to which we live in a global economy. Much of what we do still happens within our own national borders. In the next section of this lecture, I'm going to go on to talk about a second main theme of the period after World War II, which is about the rise of the welfare state.